Okay, I am delighted to be welcoming back Luke Winchester from Merewether Capital. Luke, how are you?
Good, thanks, Mark. Good to be back.
And for anybody who mightn't have come across Merewether Capital or yourself before, do you want to just give us an overview of Merewether Capital and the kind of stocks strategy that it employs?
Yeah, sure. So Merewether Capital, we're a recently launched microcap fund, officially launched in late November, sort of early December last year. So timing could have been a little bit better given the current markets. But, we got the fund away nicely, good base of investors. Yeah, I mean, other than the market and performance, which obviously, wish could be a little bit better, things have gone pretty well. My universe ties very closely with yours, actually. So, microcaps, sort of that sub sort of 200 mil market cap. But in particular, I focus on, as you term in those industrial microcaps. So tech, consumer services, heavy industry, things like that. So I try to find businesses that are profitable, or if not, like a couple of names I'll bring today, certainly on that trajectory. And have a long operating history, well-defined products and markets, things like that. So yeah, that's Merewether in a nutshell. It's very, very similar focus to what you attract with coffee, and that's why I'm happy to chat a couple of stocks today.
Okay, great. And actually, the two stocks that we're going to talk about today have actually presented in the most recent past. The first one we're going to talk about is Global Health, and the second one, Knosys. And just so people know, I'll link in the description in the show notes below to those presentations on the Coffee Microcaps YouTube channel. So if anybody wants to delve a bit deeper, they can go back and watch the company presentations. But let's talk Global Health first. For anybody who hasn't come across the stock, how does Global Health make its money?
Yeah, so Global Health's a medical software business, primarily SaaS recurring revenue, as most softwares have pivoted to in recent years. The business has had a long history, both as an operating business and also listed on the ASX. But I really became interested in this business a couple of years ago when Michael Davies came in as CEO, who, again, I encourage people, as you just alluded to, go and watch Michael present the business's story. But the reason why is that Global Health prior to that was a software provider with a large suite of products addressing a few different markets. And in a few ways, I guess the business was a little bit unfocused. And so Michael comes in, he brought his experience from Macquarie Telecom, big, large listed ASX business, was a chief revenue officer at Macquarie Telecom. So he comes to Global Health and brings enterprise experience, sales experience, and was basically looking to take what was a good product and really focus it to some key niches, expand or accelerate the product development path that they were on, and really basically just take the business to the next level. So I think he's done a pretty good job of that. When he came into the role, he was quite honest with shareholders, and if you go back and look at his presentations, you'll see the same. He did sort of say this would be a journey. It wouldn't be from day one that the business would hit the growth path that he was looking for, but sort of said that sort of 12 to 16, 18 months was where he targeted the business really starting to ramp. And what gets me excited is, I think, particularly, if people go and look at announcements in the last sort of month or so, I think that sales engine that Michael's put in place is really starting to hit its straps. Sort of 4 or 5 contract announcements in the last month or so. All of them individually, not hugely material, but combined, you start to accrete some real revenue growth to the business and really start to like I said, bring that plan through that Michael had sort of put in place 12 months ago.
So is the investment thesis, I mean, it's hard to say it's kind of a turnaround. Is it more, a new CEO and kind of coming in and unlocking the latent potential that was there? Is that more the kind of investment thesis, that there's a good business in there, but it for whatever reason historically, it just mightn't have really kind of got to where it potentially could get, and like kind of Michael's the key now to kind of unlocking that latent potential and, you know, addressable market in front of him. You know, is it large? Is it you know, reasonable? What way do we look at it?
Well, yeah, I'll answer the first part of that first. So I think that's right. This isn't a true turnaround. It's not a bombed out business that needs someone to come in and, you know, reconfigure operations, strip out costs or anything like that. The way you phrase it, you know, is exactly how I think about it. It's a business that was, you know, small but profitable, had a good product, but sort of, you know, didn't have the structures in place to really take it to the next level. And maybe needed someone who had that enterprise experience, particularly that enterprise sales experience, to come in and put the structures and the processes in place to allow it to happen. So, you know, talking to Michael, I mean, things as simple as the business didn't have any sort of CRM software or you know, structured sales software. It didn't have a formal pipeline established. Had only tendered for a couple of contracts in the year prior to Michael coming on and had won both. And so he sort of looked at the situation and said, we're not tendering enough, we're not out there enough, you know, we need more structure to our pipeline, more structure to our approach to market. And I'm sure for him, you know, it was quite simple fixes, but it takes time to obviously put them in place, have them permeate through your company and culture. And he brought in some people, you know, some from Macquarie Telecom that he's familiar with, and others throughout the industry to really put the team in place that he felt he needed. To answer your second question, it's quite interesting. So the business, I think, has pulled back its focus. So it doesn't go out there and say we're targeting this huge addressable market of you know, medical software in general to all sectors of the industry. He's actually refocused the business, I think quite rightly so, to three key areas, being mental health, community health, and also small private hospitals. So looking to really drive penetration into those key areas, and you know, like I said, you look at the recent contracts, doing a very good job of that. Now, you know, the potential is there. The business, the software, it can be enterprise and much larger scale level. But to go and compete with large hospital networks, you know, there's some big boys in that arena, mostly US-based software groups. So, you know, go after the smaller, low-hanging fruit where you can provide your expertise and speciality, particularly for small Australian operators where the business is configured to Medicare rebates, funding sources, the complexities of the Australian system, and then, you know, sort of grow the business and of course, you know, some far time down the future, maybe you look to move into that broader medical space. But you know, my estimations of what the current addressable market would be, maybe somewhere in the realm of sort of 20 to 30 mil ARR. Business currently does about 5 to 6. So, you know, even in that niche that they're targeting, I think there's still the potential for some strong growth over the next few years.
And in terms of, if we flip the coin a bit, in terms of risks kind of moving forward for the business, is it, you know, just this like slow burn, you know, enterprise sales, but by their very nature, you know, these are core operating systems for the hospitals that are going to be using them, so they're not going to switch lightly or implement lightly. So is that one of the key risks? It just takes like so much longer. You know, you've got these costs of these sales guys and teams behind them who are, you know, on the payroll, but, you know, the equivalent revenue isn't coming in just now. Or is there another risk of, you know, an integration goes badly wrong and then they have to, like, you know, throw a whole lot of money at it to kind of eventually get it right?
Yeah. Look, I mean, you've highlighted two good risks there. The first one, I think, is very valid, and to be fair, was probably playing out until the last month or two. So you're right, long sales cycles, long implementation cycles. The beauty of medical software is that once you're in, it's very sticky, and you know, Global Health sort of can attest to that with the long customers that they've had in their legacy software. But you're right, Michael comes in about a year ago. He really fleshes out that cost base with sales staff, you know, flesh out the C-suite of the business as well, and some developers to accelerate that product development. He probably added about $1 to $1.5 million a year of additional cost to the business, which swung the business from a small EBITDA profit of maybe about $500,000 to an EBITDA loss last year. It will likely still be a small loss next year, despite the revenue growth starting to come in. So that's that is the risk, is that you've loaded up the business with costs for growth, and if that growth doesn't come through, you've turned a small profitable business into a loss-making business. For me, as long as I believe there's rational management in charge of the business, I know there's a profitable business under there somewhere that can be pulled back to if the business plan's not working. So I sort of can look through that a little bit. But what's really de-risked that is the last couple of months, where I think, that sales engine and those costs that have been put in place, you've really seen the fruits of that come through. So, even in the last, call it 6 odd weeks, from a business that's doing a touch over 5 mil recurring revenue, they'll probably add, 8 to 900,000 just from what they've announced in the last few weeks. Now, long implementation cycles, so I wouldn't expect that to come into FY23 straight away, but it underpins, on my numbers, somewhere around sort of 25% revenue growth over the next year or two, just from what they've won in the last few weeks. And all the commentary is that, Michael's confident of continuing that momentum and winning more. It is a space, certainly, where if you can sort of get that foothold and that momentum going, success can breed success, because operators, they talk to each other. They know what their peers are doing. They know what software is being used. If people are having success with it or issues with it, it permeates through the industry. So good sign they've got that snowball rolling. I think that machine's really humming now. So yeah, look, I think you're underpinning some growth with just what's been announced, with the potential for more to come on top.
So if we look forward, obviously the result is going to be out in a couple of weeks' time. But is it more what people should be looking out for? It might be, if we take it over the next 6 to 12 months, is these small incremental contracts that are coming in, adding to the base. I mean, there might be a larger one that comes through, but it's more that the kind of the clock keeps ticking. They're adding, here's another little contract win here, here's a contract win there, and as we kind of move through full year, half year, next year's full year, the revenue impacts of those are starting to build on each other over the next, let's say, 3 odd results, 18 months.
Yeah, that's right. So, as we see here today, 18 mil market cap, 6 mil cash in the bank. So there's, plenty of capitalization behind that balance sheet. I don't think there's any issues around liquidity or anything like that, particularly given the contract wins, I think really underpin that revenue growth. And I wouldn't expect costs to continue to scale up the way they have. I think Michael's been pretty clear that that base has been put in place now, and it's about leverage over it. And you're right. I mean, I expect to see more little contracts come through, maybe some larger than others, and you start to see, maybe a re-rate on an individual announcement. But otherwise, just that compounding effect of these smaller contract wins all adding up. One of the benefits they do have is actually their most recent announcement came with some large professional services revenue. Now, again, it's not the most high quality revenue, but it's cash in the door. And so it will certainly help as far as the FY23 result goes, and may actually bring them closer to that sort of EBITDA cash flow break even, just on the professional services they expect to recognise from a large contract.
Okay. I'll keep an eye on that one. And then and second one for today is Knosys. As I said, business I think is presented 4 times in total for Coffee Microcaps. So I'm sure some people might have caught it in the past, but if they haven't, can you just give us an overview of the Knosys and how it makes its money?
Yeah, so just a brief one with Knosys. So rewind a couple of years, the business had one core piece of software, which they call Knowledge IQ. It was actually developed inside of ANZ and then spun out. And subsequently went on to win Optus as a large enterprise customer. So it's knowledge management software, geared towards enterprise. the business sort of hit a little bit of, a roadblock, I guess, where they were struggling to win that next large enterprise client. And so the decision was made to acquire a couple of other businesses to try and sort of bring forward that scale, that break even, or get some, real revenue base of the business. So they acquired a business called Green Orbit, which is an intranet business, and a business called Libero, which is library management. So, despite being three separate businesses, there is sort of cross-sell between them. They all sort of feature that knowledge management, or how information, I guess, is presented or collated for employees, how it's accessed by them. And so the business now, again, as we sit here today, 21 mil market cap, 4 mil cash in the bank. But what those acquisitions have really done is sort of scale up that revenue base behind it. So 9.5 mil annualized recurring revenue at the last result. But what I really like about it is essentially break even. So, you've got a business here today with a solid revenue base, roughly break even at its costs. They explicitly call out in the last report about, operating leverage really starting to shine through, similar to Global Health before. Some costs were put in that we should now see some scale over. And some recent contract wins, and go back again to that conversation with Global Health. There's actually some nice comparisons between these two businesses. Some recent wins were with Services South Australia, Services Tasmania, and Health Direct Australia, which are all government organisations. I think it bodes well for Knosys to get their foothold into these government organisations. Really increases the odds that they can win more, land and expand within them, and really go from being just a enterprise provider to also shifting across to government as well.
And three distinct businesses, and I think the other thing to call out maybe on Knosys is it's not just an Australia-focused business like Global Health. And those acquisitions that they bought have given them now an international expansion opportunity and scope as well. So going to be a benefit of this Aussie dollar, US dollar exchange rate now currently going to be a help to them. Is that part of the investment thesis? The fact that they can now have these opportunities to grow internationally, and because the enterprise market in Australia, it's, I'm assuming, quite small and very competitive, because there's not a lot of enterprises that of the scale that Knosys do, and we're talking, when we say enterprise, I think Knosys call it, it's businesses that have over 500 or even 1,000 employees. So
yeah,
those number outside of government, there's not a lot of private businesses who are going to be at that scale in Australia.
Yes. Yep. So they started to try to shift their core knowledge management to what they term the mid-market, with a more cloud-based product, and some tweaks to it. But you raise a very good point. So the acquisitions, they actually acquired some real diversification across the business. So start with Green Orbit. Green Orbit is primarily a US-based business, but also intranet software, mostly for small, medium businesses. So you go from being a purely Australian enterprise-focused business to now US-based, and also bring some small business. And then Libero is a German-based business with primarily European customers. Again, probably more focused at that library space, being more mid-market, I suppose. So it did a really good job of expanding the business geographically, and also the customer base through the spectrum of businesses, not just enterprise. Wait and see. I mean, John Thompson, the CEO, again, encouraged people to look at the presentations he's done with you. He's optimistic on the cross-sell between the three modules. So we wait and see how that goes. But what they've really had success with is actually just driving growth in these acquisitions. So they haven't just acquired revenue that then stagnates or trying to just harvest cash flow out of it. Green Orbit's actually grown quite strongly since they've acquired it. Part of that was upgrading the software to cloud-based and sort of rolling out the new version to clients, so you get an upsell to your existing customers. And Libero is similar. It's a bit earlier on. The Libero acquisition was made not too long ago, so give it a bit more time. But again, early signs is that they're still seeing some growth in that business. The knowledge business had sort of matured a little bit. So, you know, and you'll see that if you look at sort of charts in their latest results, some of the last couple of years, that revenue line had really flattened, which is why they look to acquire. But again, I think you know, John and the team are confident that they can sort of continue to grow that aspect of the business through government, through mid-market. And, you know, my original thesis for Knosys was always, as I said, the business was roughly break even. You weren't taking much liquidity or capital risk. And if they did win sort of one or two more large enterprise clients, it could really tip the business, not only into profitability, but maybe just, you know, accelerate that scale. And, you know, you can sort of put some excess profits back into sales and marketing and really try to accelerate that growth. So, yeah, that's still there. We wait and see. You know, they talk about having tenders out in the market sort of at every update. It's you know, a bit of a blue sky opportunity. I certainly don't think it's in the price that if they could land another large enterprise deal, which are quite, you know, large, like ANZ and Optus are both over $1 million a year revenue to Knosys.
And risks to the business. I mean, you talk about ANZ and Optus, obviously losing one of those would obviously be, you know, a key risk. Anything else that, you know, keeps you awake at night when you're thinking about the Knosys investment thesis?
Yeah, look, as far as, you know, like a catalyst risk like that, ANZ and Optus for sure. I guess the mitigation to that is they've both renewed numerous times and also expanded the software. That's given me a lot of confidence actually in the business that, you know, I don't think this is legacy software that just sits within ANZ and Optus because, you know, they're enterprises that don't update their product suites until, you know, a decade or two. They are continually expanding their usage. Optus was the most recent to do that only earlier this year. ANZ had actually done it twice. So it's a risk, but one that's, you know, I'm comfortable with. Other than that, I think your biggest risk is just, you know, opportunity cost with a business like this. You know, like I said before, if the acquisitions of Green Orbit and Libero weren't made, the knowledge management business has effectively sort of stalled out for the last couple of years. So, you know, I think the business unable to really drive that growth from winning contracts, winning customers. But like I said, similar to Global Health, that's starting to be de-risked a little bit. You know, lately there's been a few good contract wins. Not any of them material in and of themselves, but you add them up, you start to get some solid ARR growth, which we saw the last quarter. You know, they tacked on about $500,000 ARR to that, taking it from sort of 9 to 9.5. So yeah, you know, these smaller contracts really start to add up. Keep winning them, and similar to Global Health, you put those excess profits back in and really just build that sales engine and hopefully accelerate it even further.
So if we also kind of do a bit of a forward look, you know, 6 to 12 months, are you more focused on how the new acquisitions are going, you know, because they seem to be the kind of bit of a growth engine? So, you know, when you dive into the segmentals of the result, you know, how Green Lantern's going, how Libero's going, and if they manage to land a big enterprise deal in the knowledge management business, you know, well and good. But is the focus more on those acquisitions and, you know, how they're kind of contributing to, you know, the top and the bottom line of the business overall?
I think so. And Knosys, you know, they're both similar businesses in a way where, you know, roughly break even. New CEOs have come into them to really sort of drive that latent potential, I think, as you put it with Global Health. Knosys is a bit further down that line, mostly because the acquisitions, I think, have brought them closer. So, you know, you're talking, you know, nearly 10 mil ARR, which is a number that a lot of software businesses sort of strive for, admittedly acquisitive rather than organic. But that should give them, you know, a solid base to now scale from. And they talk about that. So in the last update, they talk about really starting to see leverage from revenue growth. So for Knosys, of course, we want to still see that growth. You want to see them win contracts. If they can land another enterprise, it'd be fantastic. But being a bit further down that line, for me, also starting to see that profitability come back into the business. They roughly break even. You know, if they can get back to sort of, you know, $1 million, $2 million profit, that's sort of what I want to see. Maybe not this year, but certainly over the next year or two, and working towards it over FY23.
Okay, good. Luke, we'll leave it there for today, but I do want to just hand off to our audience. If anybody wants to find out more about Merewether Capital, what's the best ways to get in touch?
Yeah, merewethercapital.com.au is the website. I've got the standard sort of monthly reports where I have commentary on the portfolio and stocks. Also got blogs up there. So I'm trying to get a little bit better at getting some blogs onto the website and talking about companies in the portfolio. So yeah, jump onto there, have a read. I'm on Twitter at Luke Winchester 9. There's also an official Merewether Capital, which it links to that as well. There's the two personalities on Twitter. But yeah, look, or just email me, luke@merewethercapital.com.au. Always happy to chat the fund or chat specific stocks.
Okay, great. Luke, thanks very much for joining us today.
Awesome. Thanks, mate.